What's up, everyone? It's Karthik with MoneyVest. So in this video, we are going to be talking about Jerome Powell's speech on August 23rd at the Jackson Hole Economic Symposium, as well as the Parliament of Japan holding a special session for the BOJ, the Bank of Japan, for them to address why exactly did they raise interest rates over in Japan. So that's exactly what we're going to discuss in this video. The focus of this video is going to be on fixed income. So we're going to be covering the bond market as well as the foreign exchange market with the Japanese yen as well as the US dollar, as well as volatility spike that is potential to happen in the next week here. So this right here is going to be Friday, August 23rd. And that's going to be the speech from Chairman Jerome Powell at the Jackson Hole Economic Symposium, which historically has not been the best day for the markets in more recent history. And this right here is going to be the Japan's parliament to hold a special session on August 23rd next week for the central bank, for Bank of Japan to address and really just discuss the recent decision to raise interest rates over in Japan as well. So the governor of Bank of Japan is invited and is going to be attending this event. Now, coming over to, by the way, before we get further, make sure that you do check out this video. So this is a video that I posted yesterday going over the S&P 500, the NASDAQ, as well as the Magnificent 7 stocks, almost a 25-minute video going over the entire technicals. Definitely do check this video out because I'm not covering the technical analysis on individual stocks in this video, but this right here is covering all of that. So definitely do check that out as well. So coming over to how this all started, right? So we already know that the Federal Reserve embarked on this massive mission to control inflation, right? That was their goal since the beginning, after, of course, suggesting for inflation being transitory, which they were completely wrong on. They started raising interest rates in March 2022. So this right here is the US government 10-year treasury bond. And you'll notice that yields absolutely spiked from 1.5% to now sitting well over 3.8. They kind of peaked out at well over 5%. This is the longer end of the curve, which is the 10-year treasury. And after the Federal Reserve started raising interest rates more aggressively, they actually stopped raising interest rates in August of 2023. So this right here is around the time when we basically stopped. So this entire timeline, interest rates just kept continuing to push higher, which pushed the spread between the 10-year treasury and the Japanese 10-year bond to a high of over 4%, which is what I have over here. So if I remove for the Japanese yen against the US dollar, this right here is what you'll notice is the spread between the 10-year treasury in the US and the Japanese 10-year bond. So again, coming over to March 2022, so this right here is about the time when they started raising interest rates, and then of course it peaked out well over 4.5%, closer to 4.4%. And this right here is the recent decline in that spread because of two reasons. Those two reasons are the Japanese, of course, raising interest rates, so their interest rates are going down, while the US is now on a path to lowering interest rates. So if there is so the worst case scenario for the markets going into next week really is going to be a very dovish tone from the Fed and a hawkish tone from the governor of Bank of Japan. Reason being is because if the Federal Reserve, Chairman Jerome Powell, is dovish, that means he is basically opening up to the idea that the US is going to cut interest rates, maybe in September, maybe a little bit later this year. We don't know. So that's going to push yields further down, which is the 10-year treasury. And of course, the entire curve, because even shorter end of the curve, longer end of the curve, doesn't matter. Interest rates in general, in anticipation of that cut, are going to come down. And on the other hand, if we have a hawkish tone from the governor of Bank of Japan suggesting for more potential increase in interest rates or maybe a few more rate hikes, why? Because they need to control and stabilize the Japanese yen against the US dollar. What that's going to do is going to push this spread even further down. And this is actually not good news because that is really what's going to create more unwinding of this entire carry trade over in the world. Because as we know, that the carry trade basically started when people were able to borrow in Japanese yen at lower interest rates and, of course, invest in higher yielding assets, especially the US dollar as well. Because what that's also going to do is it's actually going to push the US dollar against the Japanese yen lower. So this right here, now what I have is not only the spread between the US 10-year treasury and the Japanese 10-year bond, but also I have here the US dollar against the Japanese yen. And you'll notice that they actually move in tandem with each other. Why? Well, simple reason, because of that spread we discussed earlier. As they are moving higher, they're moving up together. And this right here is the recent sell-off that we witnessed after this spread coming down with, again, market's expectations for the US side of things for rates to come down and the Japan side of things for rates to go up. And if that were to continue, there's possibility for a little bit more unwinding of this overall trade, and the US dollar, there's potential for it to depreciate or devalue further against the Japanese yen. Now, going over to some of the levels to keep in mind going into next week, we've got a very strong support, seems like, on this spread around 2.85%. We actually bottomed out at 2.8 and a quarter, and of course stabilized a little bit. And if we drop further down, I think 2.46, a little bit closer to 2.5%, is where we could end up, which could once again reignite some of those fears around the carry trade in the world. Now, coming over to the US 10-year treasuries more specifically, this is just a 10-year treasury bond over in the US, which has been falling over. It peaked out back in October of 23, and then another recent peak here in April of 24. Markets expectations are very high for more potential rate cuts in September, starting September, of course, later this year. About 100 basis points. We've already actually fallen closer to 100 basis points, if not, I think, close to 110 basis points. So we peaked out at 4.9%. Right now we're sitting at 3.8, so we're already fallen over 100 basis points for the 10-year treasuries, and now we're sitting at the support around 3.7, 3.75%. If we were to fall further on any dovish comments from the Federal Reserve Chairman Jerome Powell, and we also have the FOMC minutes coming out next week, and in those expectations, if there's any dovish comments from the FOMC members, there's possibility for us to see a bit of a breakdown for the fixed income for 10-year treasuries, and of course for us to fall further. I'd be keeping a close eye at 3.2, 3.2.5%, a level that, again, we have validated in the past. And what is that going to do? Again, this spread's going to come down. So basically, this spread is going to potentially come down further, coming down to as around 2.46%, bringing potentially the US dollar further down with it, which is going to create some more, again, the unwinding of this carry trade even more. Now, one more chart that I want to show you is going to be this one right here, which is essentially more recently, you'll notice how correlated the US dollar and the Japanese yen is with the S&P 500. So this is only going back as far as the beginning of this year. So January of 2024, you'll notice that as the US dollar continues to appreciate against the Japanese yen, the markets have also been pushing higher. It's like literally picture perfect. It's beautiful. They both move in tandem with each other. But this right here is the dip that we witnessed for both the S&P 500 and, of course, the US dollar against the Japanese yen. They both started falling and they both started recovering together as well. They were both going up at the same time. Now, as I said, next week is going to be very critical for the market. If there's any comments from Federal Reserve Chairman Jerome Powell, if there's any hawkishness, that is the only way we're going to be a little bit more safe going into next week. If there's any hawkishness from the chairman of the Federal Reserve, Jerome Powell, and any dovishness from the chairman of, or the governor of BOJ. But if those things switch, if Jerome Powell is more dovish and governor of the BOJ is more hawkish, then I think there's possibility for this US dollar to depreciate further against the, actually this is the US dollar to depreciate against the Japanese yen. That's going to put the spreads, more pressure on the spreads to come down further, which again is going to create some more volatility here on the VIX, thereby creating some more risk-off environment for the S&P 500. So that's what I have for you in this quick update and quick video. Next week is going to be very critical. Watch out for Friday, August 23rd. We will be live to cover that. But it's really going to be the bond market that's going to be making a lot of the decisions for the markets moving forward, because we have very, very important speakers for next week. Let me know your thoughts down in the comment section below. And what are you expecting from the markets going into next week, especially for Friday, August 23rd? Are you expecting for Jerome Powell to be more dovish, hawkish, and of course, the governor of Bank of Japan? And what are you expecting from them as well in the future? My personal opinion is that I think Jerome Powell is going to be a little bit more open to the idea that rate cuts are coming in September. FOMC minutes are also going to address that very fact, but then it really is going to come down to the governor of Bank of Japan. How open are they to the idea of keeping rates where they are, or raising interest rates, thereby putting more downward pressure on the spreads between those two pairs, and thereby, of course, putting more pressure on the US dollar to depreciate against the Japanese yen, thereby putting more pressure on riskier assets, as we've already seen, and therefore, of course, accelerating a little bit more of this unwinding of this carry trade that we've seen over the last couple of weeks. So let me know your thoughts down in the comment section below. Hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. And as always, happy investing. I'll see you all in the next video.